Stocks and the stock market can make many conversations lively, to say the least. And the last few years have seen market gyrations to test just about anyone's investing theories and appetite for risk. Your host, Terry Wheeler, wants you to do more than just survive the turmoil, though. He wants you to thrive. I'm Patrice Sikora. So, Terry, talk about the stock market and some of the reasons we can see these big movements.
Hello, Patrice. Very nice talking to you today. Stock market is one of my favorite subjects because it's so challenging, and yet there are some strategies that I think are very powerful that we'll talk about today. But why do stock markets crash? It's often because of development of bubbles. So you get these normal market cycles that you have kind of early, mid, late stage, and then recessions. A lot of times the late stages, you get too much excitement and these bubbles occur and you get valuations that just don't make sense, and then they have to naturally reset. But it's very normal for markets to expand, contract. But the key is some of these expansions are a little bit too much, and then some of the contractions are too much, which spells risk and opportunity. And I think understanding that risk and opportunity is a little bit of how you can do well in the stock market. And first and foremost, you don't want to panic.
Hmm.
So the markets, if you're going to be invested and you're going to not use a strategy, what we call naked in the market, you got to have a strong gut because you're going to go through some really tough times and big losses at times.
Yeah. Now, you mentioned these things come in cycles. How often usually does this happen?
That's a good question, and that's why it's hard to predict the market. Is you could have business cycles as short as a year and as long as 10 years. So they can
Oh,
be very extended at times, and they can sometimes expand and contract very rapidly, usually because some sort of an economic event. So it's even though the stages are somewhat predictable, the timing of them are very, very tough. So you need systems and things that will help you control your emotions and help you systematically invest in the market, in our opinion, in order to do well.
you used a word there, timing. Talk to me about timing the market.
So I'm not a big market timer. I don't think timing is a good strategy. If people were great timers, they would just be investing in their own portfolio and wouldn't have to work other than trading. I think timing is extremely difficult. And that's why the overall market beats most portfolios. If you just buy the whole market, it beats most portfolios 80 to 90% of the time by a lot of statistics. So can you beat the market, or can you at least keep up with the market with less risk and less volatility? Those are kind of the strategies that we try to focus on as opposed to trying to time the market.
Buy and hold. Does that fit one of your strategies?
So buy and hold is how I was raised. So I began with what was then called Dean Witter, and very much in the philosophy of Warren Buffett and value-based investing, and buy good companies and hold on forever. Over time, we've realized that retirees, especially, and those in the sprint to retirement, they don't have the time necessarily to wait out some of these recessions if they're withdrawing money. So if you're withdrawing money from your portfolio and you go through a 10, 12, 13-year time frame, which we've seen in the past, where the markets have basically gone up and down, but at the end of the 10 to 13-year period, they've gone nowhere,
Yeah.
it can cause your portfolio to implode. So we put some defense in our portfolios and don't simply buy and hold and stay, again, what I call naked in the market. With that said, we do take a portion of assets, and we typically will do a strategy like that, but it's typically only about 25 to 35% of somebody's stock market allocation.
Talk to me about your strategies then.
Well, we like to do what we call defined outcome investing. And what I mean by that is we want to know what the downside looks like and control some of those risks. And defined outcome can vary widely as to the strategy you're using. But let's look at the naked in the market strategy, meaning just buy stocks, and hopefully, whether you're timing the market, trying to pick the winners or losers, or buying the entire market through indexing. When you look at defined outcomes there really aren't any,
Hmm.
meaning, what if the market drops 80%? What are you going to do? Well, you don't know if you don't have a plan other than hold on and hope. we don't consider hope a strategy. Now, with that said, historically, markets have recovered. So there's good reasons why people say just put your statements in the dresser drawer or the desk drawer and don't look at them. And eventually the markets will hopefully recover.
But what if you don't have
We
the
don't,
time?
yeah. And if you're retired, you oftentimes don't have the time, and it can really affect your ability to live the life you want to live. So we think maybe even watering down your returns a little bit, taking a little bit less on the upside, but in return, not having these big downside swings. We like to embrace strategies that do that.
Okay.
So we have two primarily. So let me give you a quick overview. And then we have a third that's kind of a hybrid. So one approach, both approaches are variations of what's called structured investing. And structured investing is a form of defined outcome. So one approach we do, it depends on the day that you go into the market. So the amount of the upside of the market can vary based on market conditions. So currently you can get between 14 to 16% of the upside of, say, the S&P 500. Now, what that means is the market is up 10, you make 10%. The market is up 16 and your cap was 16, you make 16%. The market's up 30 and your cap was 16, you make 16%. So you're giving up that crazy, red hot bull market return that goes above 16% as an example. But that is rare. So if you like what you're getting in return for giving up some of that upside, it's a good deal. So what are you getting in return? Well, let's say we go in and we get a 14% cap, hypothetically. Now, that's right in line with today's rates. But again, if you invest 6 months from now, that can be a different rate. So if your cap is 14%, what you're going to get in return, as of today at least, is a downside protection buffer. And the way this works is the first 5% of a down market, you're going to lose. So if the market's down 5%, you're down 5%. But if the market is down 20%, you're down 5%. If the market is down 35%, you're down 5%. Now, if the market drops more than 35%, you start losing again. Now, this is one example of one defined outcome strategy that we do, and these trade daily. You can go into other indexes that maybe you're only getting 15% downside protection, but you're getting 20% of the upside of the market. They vary widely. So depending on market conditions, we use different strategies, but we're accepting less of the upside in order to get some downside protection. And combining that with the naked in market strategy as one step, we find that plus rebalancing can really help people in their sprint to retirement or in retirement, because it makes the ride a little bit smoother.
I can see that there'd be some comfort in knowing, all right, I may lose, but I probably won't lose more than this, and I may not share in all the gains, but I'm going to get a big chunk of the gains anyway.
Yeah, I mean, even imagine the market crash 55% like it did in the 2008 timeframe. 55% drop. Even with this, you would have been down a lot, but you would have only been down 25%.
Not 55.
Yeah, now that's much better. So for $1 million portfolio, it's still a very painful hit, admittedly, but it is much better than just being naked in the market. And then when you rebalance, that means you get to take some of that money that was only down 25 and put it into stocks that are down 55 potentially. That can really help your returns. But again, that's two of the strategies. So we've got the naked in the market, and then one of our defined outcome where you're limiting the upside, but in return getting some downside protection. The other strategy we do is where we combine an income source that preferably is going to be safer than the market. So you got to be careful as to what income source you choose, because that is the risk in this strategy. And then you take that income and you buy the upside of the market. And it depends on the market conditions, but we can typically get anywhere between 75 to 95% of the upside of the market. So it depends on where volatility is, but we call it a target 80 strategy. So we're targeting to get at least 80% of the upside of the market. And then in down markets, our goal is to break even plus or minus 1%, 1 to 2%. We found that strategy over the past 15 years has worked quite well. But again, the risk is the income. So if you choose an income item that is too aggressive, you could be losing money in those income items when they go down also. And we made that mistake in the early years of doing this strategy, so 15 plus years ago. But now we feel like we've got it pretty dialed in. And at one point, I was doing these with Coca-Cola bonds as the income source, which we feel were pretty
Mm.
safe. And now we use some other strategies, but they are strategies that we believe are lower risk than the stock market. But again, you got to focus on that income item because that is the risk. The stock market is not the risk in that strategy. But when you combine the three strategies and then you rebalance periodically, we find that gives the smoothest ride. And we believe in the long run that that will give us the best result also. So lower risk, better return is what we're all after. That's what we're going after here. But again, you have to very much focus on what is the risk you're taking in each of those three strategies. And the idea is to control some of this risk a little bit.
Do you find that your investors have their risk tolerances change with time?
Unfortunately, yes. And when I say that, we have clients periodically, and we had one again this week, that their risk tolerance changes based on their emotions, which are affected by where are we in the market. So if the market is on fire, all of a sudden everybody's ready to go out and buy Bitcoin and buy, the latest AI stock. And yes, they may have done very, very well, but they're also very high risk potentially, because when things get overvalued, they potentially crash very hard. So people get very bullish at exactly the wrong time. Now, a lot of investors do the opposite too. So the market crashes, they're knocked to their knees with that 50, 55% drop, and they just cannot stomach it anymore. So they get out of the market and go safe, so to speak, right when stocks are on sale.
Right.
So it's exactly the opposite of what you should do, but the emotions are real. And it always feels like this time it's different. The market's going to keep going down. So your emotions, I think, are a very big part of why we do the strategies we do. It gives you the courage to invest properly when you know you have a good deal of downside protection in place in the strategies that you're utilizing. So we find it lets all of us sleep easier, including myself as our clients' advisors. And I always kind of laugh because periodically I'll get clients reaching out, and their question is, "Are we okay?" So the market just crashed 30, 40%. Are we okay? And I just smile because that's when all this defense pays off. It's not when the market's high. It's when the market crashes that if you put defense in place and you're sleeping easy and everybody else is, quite frankly, quite stressed, that's the payoff. So you want to put protection in place before the crash. We get a ton of referrals after the crash. Well, it's too late. So we've got to do it before the crash, but everybody's happy with their portfolios and their advisors when the market's going up. But if they're not putting defense, it's not necessarily your portfolio or advisor. It's the whole market's going up, so everybody looks good. You don't really know how good your portfolio is until it's tested, which that happens in the recessionary markets.
All good stuff there, Terry. Is there something you haven't mentioned that you want to make sure you do?
Well, I think one of the key things would be expect these recessions. So for a retiree, on average, they're going to see about 3 to 5 recessions. It's going to average about 3 every 2 decades. The average recessionary drop for the stock market is over 30%. But things have been getting more volatile over the last 20 years, and they've averaged well over 40% drops over the last 20 years. So you've got to be ready. And people make the mistake of investing in retirement the same way they did during the accumulation years. And it's a different set of strategies that are more effective for you when you're retired, because you're taking out income. You probably don't want these wide swings. Most of our clients, quite frankly, don't need to swing for the fences. If they can get a 6 to 8% return and get some consistency, they're extremely happy. So we try to target that, but the market doesn't always cooperate. So even with our strategies, if the stock market's down 50%, that stock portion of your portfolio is getting a zero. So, but a zero is much more comfortable than
Minus.
a negative
Yeah,
55.
exactly.
So We try to segment the portfolio based on risk tolerance. So those that are more aggressive will do a slightly different proportion than those that are more conservative. The last strategy is the hybrid strategy. And that is something that we utilize using a variety of products that are put out by a company called a Nexus. And a Nexus is a very powerful innovation type company that is working to help solve some of the retirement challenges, which there are many facing Americans these days. But a Nexus has some powerful indexes that utilize some of the hedging strategies that we've kind of been talking about, but they do it in a fixed indexed annuity product. Now, I happen to not be a big fan of fixed indexed annuities until I met a Nexus, and they work with these strategies, putting them inside annuities. And these annuities allow us to we use it as a bond-like return, not actually a stock market holding, but it allows us to get potentially very nice returns, even when markets are volatile. So they've worked with a variety of people, including various Nobel Prize winners in economics, including Jeremy Siegel, and Robert Shiller. And they have two indexes we really like. We also like an index by Loomis, where they hired a team from MIT and tried to create an index that would be fairly stable. And when you do that, you might be able to get more than 100% of the index return. So their strategies, you might get a crediting rate that's 200 or 300% of an index return. So it gets complex here, but based on today's crediting rates, if you look at how you would have done in the last 20 years, if you had today's crediting rates, you would have done quite well. So we place it as a bond, but you have the potential to do as well as stocks. So that's why I bring it up in this podcast, is there are time frames it's going to really protect you. So we call this a volatility buffer. Should not be your whole portfolio, but it can play a role in a good stock and bond allocation.
MIT, where Professors Siegel and Schiller both graduated as graduate students.
yes. And you were telling me a story before we went on about how they met.
Right.
Why don't you go ahead and tell our listeners? I thought it was a great story, but
it was the first day of graduate school for them. They hadn't even started classes. Back in the day, apparently all the grad students had to have chest x-rays for TB done, and they were online, and it was alphabetical, and Schiller was in front of Siegel, and they started talking and found out that they were both studying economics. Apparently there weren't that many graduate students in economics at the time. And as they put it, it's been 50 plus years of a friendship ever since. Longer than most marriages.
Yeah. And a powerful, powerful friendship. And I mean, to think that two random people standing in line are both going to be a Nobel Prize winners is crazy. And the way they've excelled and some of the indexes they've done, they're helping to revolutionize and protect retirees. So that's something that I think our listeners should all have some sort of volatility buffer, in our opinion, in their portfolio. There's a few strategies. Okay. That's one of them that you can do for volatility buffers. So
let me ask again, Terry, how can people reach you?
So they can reach us at our website, of course, www.weariaadvisors.com, or just reach out to us and call us. It's 916-325-0130. We'd be happy to talk to you or answer any questions. And of course, links and stuff will be in the podcast notes below. So we look forward to hearing from you, and hopefully you got a few nuggets of wisdom from this podcast.
Well, there are more than a few in here, that's for sure. So folks, there's more where this came from too. And all you have to do is follow or subscribe to the podcast to know when a new episode is ready for you. And of course, please share. Thanks for being with us.
Thank you, Patrice.
Thank you.
Thank you for listening to We Money Talk with Terry Wheeler. Be sure to click the follow button to be notified as new episodes become available. Information presented is for educational purposes only. No listener should assume that any discussions or information presented serves as the receipt of or substitute for personalized advice from We Alliance Wealth Advisors, Inc. or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. We Alliance Wealth Advisors, Inc. is not a law firm or accounting firm, and no portion of this podcast should should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not appropriate for every individual. Listeners are encouraged to seek advice from qualified tax, legal, or investment advisors to determine whether any information presented may be suitable for their specific situation.